Getting rich through investing and trading sounds easy, right? Here's my story. I worked this boring 9-to-5 job, and I was not getting paid enough. One day I was having lunch with one of my colleagues. We were busy complaining about all the miserable things in our lives. All of a sudden he said, "Do you know how much an average Wall Street trader gets paid?" I looked at him with a confused expression and asked, "How much?" He said, $49.66 per hour. That's $1,986 per week and $8,607 per month. To me, it was enough. Imagine what I can do with that kind of money. I was hooked. When I got home later that day, I started to search phrases like how to become a Wall Street trader, how to make money investing in the stock market, started reading posts on Google and watching YouTube videos about the stock market. Then a few months down the line, I was ready. I funded my account. I started an individual investment account, and I was convinced that I needed to invest in individual stocks, putting a lot of thought into choosing the right ones and using an individual investment account, which wasn't the correct type of account for my goals. And the worst part is it didn't help that I started investing during one of the most devastating times, during coronavirus crash, which led my account to be in deep negative. Then, boom, reality hits. I don't know what I am doing. And experience is the ultimate key to become a successful investor. Just like what Warren Buffett said, when a person with money meets a person with experience, the one with experience ends up with the money, and the one with money leaves with experience. So I guess the stock market has left with my money, and I'm left with experience. But what was I doing wrong? And what I wished I knew before I started investing in the stock market? Here are a few things I wish I knew.
It's much easier to invest for the long term.
You need an edge to make money too.
The first thing I wish I knew is understanding the risk involved in investing and trading. All investments involve some degree of risk. If you intend to purchase securities, such as stocks, bonds, or mutual funds, it's important that you understand before you invest that you could lose some or all of your money. Unlike deposits at FDIC-insured banks and NCUA-insured credit unions, the money you invest in securities typically is not federally insured. You could lose your principal, which is the amount you've invested. That's true even if you purchase your investments through a bank. The reward for taking on risk is the potential for a greater investment return. If you have a financial goal with a long time horizon, you are likely to make more money by carefully investing in asset categories with greater risk, like stocks or bonds, rather than restricting your investments to assets with less risk, like cash equivalents. On the other hand, investing solely in cash investments may be appropriate for short-term financial goals. The principal concern for individuals investing in cash equivalents is inflation risk, which is the risk that inflation will outpace and erode returns over time. As a critical part of your planning process, you should determine your own risk tolerance, how much you can be prepared to lose should a prospective investment decline in value, and how much ongoing price volatility in your investments you can accept without inducing undue worry will be important considerations in determining what sorts of investments are most appropriate for you. The second thing I wish I knew is that I need to understand classic investment strategies. Among the investment strategies that the beginning investor should understand fully are active versus passive investing, value versus growth investing, and income-oriented versus gains-oriented investing. While savvy investment managers can beat the market, very few do it consistently over the long term. This leads some investment pundits to recommend low-cost passive investing strategies, mainly those utilizing index funds that seek to track the market. In the realm of equity investing, value investors prefer stocks that appear to be relatively inexpensive compared to the market on measures such as price-earnings ratios, expecting that these stocks have upside potential as well as limited downside risk. Growth investors, by contrast, see greater opportunity for gain among stocks that are recording rapid increases in revenues and earnings, even if they are relatively expensive. Income-oriented investors seek a steady stream of dividends and interest because they need the ongoing spendable cash. They see this as a strategy that limits investment risk or both. Among the variations of income-oriented investing is focusing on stocks that offer dividend growth. Gains-oriented investors are largely unconcerned about income streams from their investments and instead look for the investments that seem likely to deliver the most price appreciation in the long term. The third thing I wish I knew is to have a financial plan. Before you make any investment decision, sit down and take an honest look at your entire financial situation, especially if you've never made a financial plan before. The first step to successful investing is figuring out your goals and risk tolerance, either on your own or with the help of a financial professional. There is no guarantee that you'll make money from your investments, but if you get the facts about saving and investing and follow through with an intelligent plan, you should be able to gain financial security over the years and enjoy the benefits of managing your money. A financial plan with goals and milestones should be the first step you take if you want to become a successful investor. These objectives and benchmarks might include deadlines for saving certain sums of money. For example, having enough savings to facilitate buying a home, funding your children's education, building an emergency fund, having enough to fund an entrepreneurial venture, or having enough to fund a comfortable retirement. Additionally, while the majority of individuals focus on saving for retirement, achieving financial independence as soon as possible would be a goal that is even more desired. Financial independence, Retire Early, is an organization dedicated to this objective. Although it is possible to develop a sound financial plan on your own, if you are unfamiliar with the procedure, you may want to consider seeking professional assistance from a financial advisor or financial planner, especially one who is a certified financial planner. Finally, act immediately. A plan should be in place as early as possible in your life and should be updated on a frequent basis to reflect shifting circumstances and objectives. The fourth thing I wish I knew is how should I allocate my assets? By including asset categories with investment returns that move up and down under different market conditions within a portfolio, an investor can help protect against significant losses. Historically, the returns of the three major asset categories, stocks, bonds, and cash, have not moved up and down at the same time. Market conditions that cause one asset category to do well often cause another asset category to have average or poor returns. By investing in more than one asset category, you'll reduce the risk that you'll lose money, and your portfolio's overall investment returns will have a smoother ride. If one asset category's investment return falls, you'll be in a position to counteract your losses in that asset category with better investment returns in another asset category. In addition, asset allocation is important because it has a major impact on whether you will meet your financial goal. If you don't include enough risk in your portfolio, your investments may not earn a large enough return to meet your goal. For example, if you are saving for a long-term goal, such as retirement or college, most financial experts agree that you will likely need to include at least some stock or stock mutual funds in your portfolio. The last thing I wish I knew is I need to be disciplined. Stay disciplined if you are investing for the long run in accordance with a well-thought-out and well-built financial plan. Aim not to get thrilled or shaken by brief market movements and potentially sensationalistic media coverage of the markets that may cause panic. Take market experts' predictions with a grain of salt unless they have a long track record of accurate forecasting that has been objectively validated. It is essential to understand your goals and objectives prior to investing. Knowing your objectives will help you choose an investment to help you achieve them, whether they are to finance retirement, buy a home, or start a new business. It is crucial to comprehend the investment you are prospecting for as well as the fundamentals of investing, including risks, fees, and costs. Choosing the best assets or investing strategy can be difficult for new investors, and there is as much variety in the advice available as there are products available. Despite the numerous tips, developing your knowledge and having a firm grasp of investing and your goals are essential for making decisions that are likely to produce positive outcomes.